Today we will progress on these master classes on real estate investments, talking about closed-ended real estate funds. So to recap where we left it last time, we are trying to build a diversified real estate portfolio. We have discussed about the importance of having some cash on side, the importance of investing in listed securities or REITs, and now over this session and the next sessions, we will talk about investing in funds. Now, there are two types of real estate funds: closed-ended funds and open-ended funds. Today, we will talk about the closed-ended funds. The closed-ended funds do not allow redemptions for a certain period of time, but they can be liquidated on a secondary market. Primarily, they focus on generating capital gains, and they pursue high-risk strategies. Now, let's quickly compare with these funds with the open-ended funds. These funds allow redemptions. They also trade on the secondary market. They primarily look at income and some capital gains. And typically they pursue low risk strategies. So let's plot both these funds on our risk and return diagram. So we plot our various strategies: core, core plus, value add, and opportunistics. So typically we will use open-ended funds to invest in core and core plus, and we will use closed-ended funds to invest in value add and opportunistic strategies. So in theory, we would expect a higher return from the closed-ended funds. Is that correct? Well, according to MSCI, on aggregate, the US open-ended funds have generated the same returns of the US closed-ended funds. So over the next few charts, I will try to explain you why this might have happened and how it can be avoided when we build the portfolio. So let's try to understand why on aggregate the results of the performance results of the closed-ended funds have been equal or approximately similar to open-ended funds. We start with J-curve. We're putting on a timeline the hypothetical value of the closed-ended fund and of an open-ended fund. So typically what we do, we divide this timeline into a drawdown phase when we are building the position in the fund and a harvesting phase when we start receiving the returns. Now, typically the open-ended fund will have a quite a regular slope, upward slope, because as soon as you invest money, you start receiving an income, since you are investing in income-generating properties. In the case of a closed-ended funds, there might be instead a J-curve. So initially, the value of the investment might decline. And that is primarily because of the commitment fees. In order to enter into a closed-ended fund, it might take up to 2 years, because it takes time for the manager who has started a new fund to deploy the capital, which is different from the open-ended funds. We are talking here about large established open-ended funds where you might have to wait 3 months, sometimes no time at all to go in. So as you can see, it takes quite a long time for the closed-ended fund to outperform the open-ended fund. And there is a point which is the few years in the future where the two funds actually meet. Okay, so up to that point, you might, when you feed these numbers in a database and try to measure the performance, you might actually see that the closed-ended funds are underperforming the open-ended funds. So this actually is the problem why you sometimes, on an aggregate basis, we see the closed-ended funds generating similar results. So you need a very, very long time to enjoy this outperformance. Now, moving on, when we invest, we build a portfolio of closed-ended funds, we need to invest in multiple vintages. Okay, so that's basically the approach. So let's show how this actually works. Again, we have our timeline and we have our value. So what we do, we decide to allocate a certain amount of capital to the closed-ended funds. So we start investing every year a portion of that capital. So we will have the first fund, the second fund, the third fund, the fourth fund, and the fifth fund. So this is how you invest in closed-ended funds. You don't put all your money at once into one fund, but you actually stagger it. So what happens is that, first of all, at one point, the aggregate effect of the J-curve disappears. And in our example, from year 4, you start seeing that at least one fund starts generating positive returns. But more importantly, because these are closed-ended funds, we are going to have a staggered exit over a 7, 8, 10 years period, because one by one, the fund will start maturing, and they generate an ongoing amount of liquidity. Now, moving to the next stage, another important observation that can be made when we invest in closed-ended funds is the dispersion of the returns of these products. So here, this is statistics put together by MSCI. What they have basically measured is the performance of a portfolio of funds under different scenarios between 2008 and 2020. So here they look at a situation where an investor has made only one commitment, okay? So across a number of funds. So they had the maximum dispersion of returns. So we have one fund that generated like 15% and one fund that generated 4%. So it was very difficult. It would have been very difficult to pick up the right fund. However, if an investor keeps making commitments every year, this dispersion of returns reduces, narrows. Okay, so it is still there. Okay, this in a case where an investor has made 16 commitments every year between 2008 and 2020. So they really had a very, very diversified portfolio of funds. Here, the lowest, the bottom percentile of returns would have been around 7%. The top percentile would have been around 11%. So here we might really lose the benefits of investing in closed-ended funds because the returns at these levels are getting very, very close to open-ended funds. So this could be a case of over diversification. So it looks like there is probably a sweet spot of 8 to 10 commitment per year, where with a little bit of stock picking, it's possible. I mean, if we are lucky enough or skilled enough to pick the right products, we should be able to generate between 10 and 12% in aggregate. So, in conclusion, why invest in closed-ended funds? First of all, they provide access to higher return strategies. They are less volatile than listed securities, which might be very important for a certain type of investor who, for example, has to report on a quarterly basis, on an annual basis, the returns to its own shareholders, and doesn't want to show volatility of the returns. This also could be an investor pursuing a leverage strategy where they have to report the value of their portfolio to a bank that is measuring it as a collateral. So again, private markets provide this benefit. However, to invest in this type of products, it's important to invest over multiple vintages. So every year, an investor will have to invest in a number of, we have actually identified 8 to 10 funds every year in order to have a sufficient diversification that enables to narrow the range of outcomes. And finally, it's extremely important to perform due diligence on the managers with whom we are investing. So typically what will happen is that an investor will select 4, 5, 6 managers and repeatedly will continue to repeat investment with these managers, and maybe they will have a short list looking at the past track record where there is a replacement. So every year they might stop committing to the manager that is performing at the bottom of the portfolio and replace it with a new manager.